Hi everyone and welcome to my channel. Today we'll talk about how the Russia and Ukraine war affects the stock market. This is probably one of the most interesting videos I have ever made. So stick around and enjoy the video. Let me tell you something first. I have not made a video for a month, and during this time all I could think of was if my 46 subscribers were thinking that I abandoned the channel. But don't worry, because I didn't. I was away because I was teaching myself how to trade stocks. And now I can tell you exactly how the Russia and Ukraine war affects the stock market. So, let's get started. The war is here. It has arrived. Russia officially invaded Ukraine in February 24 of 2022. Especially says that in general, the global market gets weak before war, but go higher during the war and it continues to go higher by the end of the war. At the time of making this video, the price of oil and agricultural commodities have risen up. The European market is the most affected so far, but American gasoline prices are also rising up. The price of a barrel is rising up and up every day. So far, the energy prices are still the same, but it might go up as well if the war continues. Investors advise retail traders to keep calm because even if the war affects the stock market, as many times before, it will not take very long until it recovers again. It also says to mutual fund investors to not break their plan. But it's not just the retail traders and the mutual fund investors that suffers with this war. The war affects the long and the short-term investors, such as day traders, swing traders, future and option traders, and everyone else. And if you clicked on this video, chances are you have been thinking about becoming a day trader. And you were thinking how this war can benefit you or if this war could actually ruin your plans. So before I tell you how the war affects the stock market, let me explain you what a day trader is. Day traders are independent market speculators. They are all around the world, betting financial markets, spinning on their rolling chair behind their trading desks, in the comfort of their own homes. In the United States, you have to be over 18 years old. You need to have at least $25,000 in your trading account to get started in the American financial markets. When you day trade, you don't own stocks. You borrow shares from the broker, trade them during the day, and return them back. Currently, there are 13 registered stock exchanges in the United States. The major U.S. exchanges are the New York Stock Exchange and the NASDAQ, and they both open at 9:30 a.m. and closes at 4 p.m. New York time, Monday to Friday. Outside of those trading hours, the stock market operates with a lot less volatility and volume. So the reality is that the stock market almost never closes, except for federal holidays. Aside from that, the stock market is always open any time of the day or night, and you can trade outside that window if you want to. Starting a day trading career can be expensive. There will be more losers than winners in the stock market. Because when you start to day trade, you are already losing money because you have to pay your broker a fee for each transaction. And if you don't make enough transactions, your broker, in some cases, might charge you an inactivity fee. In order to get started, you need a high-speed internet, real-time market data. You need a broker that will buy and sell stocks for you right away. And you need a platform so you can give the commands to your broker on your behalf. This platform is essential because it shows you the bid and the ask prices, the charts, the momentum, the daily and weekly moving averages. Another thing that you need is a scanner to find stocks in play. A scanner is a software that you download to find stocks, and it's not free. Stocks in play are stocks that have gapped up or down significantly on the pre-market before 9:30 New York time. Stocks turn out to be in play when earning reports like FDA approvals or disapprovals are disclaimed or shocking news are announced about them, either positive or negative. After the scanner finds the stocks, most day traders watch between two or three stocks at the same time. That is why they have three screen computers in front of them all the time. Yes, you need a separate screen for each stock because there is so much information in just one screen, and especially for day trading, you need maximum concentration. Because for day traders, days, weeks, months, and years doesn't matter. Day traders respond to the market in a matter of seconds and minutes. Rarely, even the count of 1 hour is relevant to them. All of that costs money. Your scanner, the high speed internet, the monitors, the chair, the table, the chat rooms, everything. The good thing is that if you become an experienced trader, you can expect to make at least $30,000 a day. Experienced traders watch 5 to 6 stocks at the same time and they enter very large positions. Some day traders have a lot of money on their disposal and even more on average. Remember that there is no money being generated in the stock market. The money that is in the stock market is the money that the traders like you and me put in there when we sign up with a broker. The money that you are wishing to make in the stock market belong to someone else just like you. Someone that woke up early in the morning, cooked his oatmeal with cinnamon and blueberries, went to the gym, showered and dressed, sat in his trading station, and asked God to bless his day. He had promised your money to his girlfriend. He had already counted on your money for his wedding ceremony, for his kids' college, and for his home beach. And he invested on his education to learn how to take your money while you are trying to take his. Because day traders are in this game for the short term. They are often called scalpers. They enter the market in the quiet times and they leave on the wild times, take their profit in a matter of minutes, and they go enjoy the rest of their day. Most experienced day traders actually only work 1 or 2 hours a day or until 11 a.m. New York time. They work between 10 and 11 a.m. because it's during this time that the stock market has the highest volume. Most day traders expect to make a living off trading and they can make an average between $500 to $1,000 a day with an average size account of $30,000. You need to have a strategy and a good risk management plan. All experienced traders have that. You have to check the index indicators such as S&P 500, the Nasdaq, because when they are red or down, it means that the market is weak in general, and it means that the other traders are going to see this as a sign for them to go short. Short means that you are buying a stock hoping that the price go down even lower so you can buy them back and return them to a broker and make a profit. To go long means you are buying a stock hoping that the price will go higher so you can sell them for a profit. But the world is making it very difficult to predict the next trend, the color of the candlestick, or the support and resistance level. This index are red. Traders see it as a sign to take a certain action. But because of the war, the stocks market right now, it's not responding to the index indicators. as usual. So all traders want to predict what is coming next, but the war changed the sentiment of the market, making it harder for everyone to make a calculated bet. As an investor said, this is a period where the anticipation of the event is worse than the event itself. However, this event have not yet impeded the export of commodities such as oil and natural gas. The price of the stocks went up just for the sake of the announcement of the war. You see, because of the war, a lot of currency traders were sure that the euro would go up. So, what they did? They were bullish on the European stocks, expecting the price to rise, but they lost the bet because the stock actually went down. On the other side, lots of currency traders in the Japanese yen lost money because they were bearish, which means they were expecting the price would go down. But what happened? The stock went up instead. Yes, this war is calling out beginners traders to sit behind the desk and make a bet. Very cheesy, right? Because as more traders are in the stock market, as more volume are there, which means the amount of money you can make is increased. Institutional traders are different. They are professionals that can efficiently trade multiple stocks at the same time. They have millions of dollars available to trade. But notice that the money that they are trading with are not their own money. This money belongs to the institutions, companies, and banks. Individual traders often let institutional traders dictate the market. As many experts have said, a trend is your friend. Let me tell you a story. I talked to one of those institutional traders one day and I told him I was an inspiring retail trader. He frowned, adjusted himself on his seat, and folded his palm gesture on me and said, "The stock market is a casino. The traders are the gamblers, and we are the owners of the casino. Eventually, the gamblers will make money, but it's about time until they lose it all for the casino." Retail traders operate in a level of desperation for quick, easy money, but the big money is in the long run, and a day trader can never make real money with that mentality. But he takes me back, and he asked me to take me out for dinner. You see, this is what I'm trying to say. The Russian and Ukraine war affects more the casino than the gamblers right now. So if you were wanting the news about the war, either good or bad, when they are trading commodities or currency, for example, is just a code that tells them if they should go short or they should go long. Most affected by the war in the stock market. Exactly, the institutions, companies, and banks. The oil company of London, the BP, is about to delete 20% of its share, part with their Russian counterparts. The stock exchange in Europe, the stocks Europe 600 and the DAX in Germany went down. This is because the banks in Russia are suffering heavily the effects of this war. The banks need money, and in order to incentivize people to make their money, to keep their money in the bank, they raise the interest to a rate to 20%. And now the banks are using its cut out savings to incentivize people to get mortgage loans. Well, the Treasury Department is even talking about cutting